Well, according to Bloomberg data, David Konrad is one of the world's most accurate analysts on JPMorgan Chase. He's a managing director at Keefe, Bruyette & Woods in charge of large-cap banking stocks. He's also a Bloomberg Best, and he joins us live now from KBW's trading floor here in New York. David, good to have you here with us.
Thank you.
Investors definitely liked what they got from JPMorgan. Did they do as well or really surpass your expectations?
They really did this quarter. I think, what we've been used to at JPMorgan is really solid results, good risk control, but we haven't seen the top line growth. And I think this quarter was really the first time that they beat us significantly on the top line, and that's why the shares are up today.
They definitely set the bar high for everybody else reporting. Are they, we always seem to separate JPMorgan from the rest of the pack. Is it right to do so based on these earnings, and should we not get too excited about what's to come from the rest of the banks?
I think there's some truth to that. I think with JPMorgan, it feels like what we've seen the past couple of quarters is just a really good integration, perhaps, of the Bear Stearns deal, the Sempra acquisition where they bought the commodities business from Royal Bank of Scotland. It just feels like all these businesses now are integrated, and they're really moving ahead nicely. I would be very cautious of really applying these trading numbers to the other banks. Having said that, though, Goldman Sachs, we're down in our estimates something like 50% for FICC trading linked quarters. So, I do feel better about those numbers coming up next Tuesday, but I don't expect them to be quite as strong as JPMorgan's.
Yeah, I wonder about trading, because we see guys down here being let go, guys at other banks being let go. If people are trading less, it's got to affect every bank eventually, right? I mean, do we expect to get a disappointment on trading revenue from JPMorgan next quarter?
Well, I do think, it's going to be tough in the terms of we are in the summer months. It's typically the third quarter is seasonally the slowest quarter for these firms. So I would anticipate my estimates to come down relative to this level in the next quarter. But, it feels pretty good as we look through, 12 and 13.
David, Jamie says that you can rule out large-scale job cuts at JPMorgan. Do you buy it?
I do in the aggregate, certainly. I think what we're going to see from a lot of the investment banks is perhaps the U.S. jobs maybe being trimmed quite a bit, but there's going to be a reallocation of resources in the investment bank to the international business. And, that's something that JPMorgan's growing pretty meaningfully right now. So I think on the aggregate we won't see job cuts, but there'll be a shift in resources.
The bank released $1.2 billion of reserves. That kind of skews the picture a little bit. Do you expect that kind of number to keep coming in the next few quarters, or should we see that taper off?
Taper off a little bit. We were actually looking for around $1 billion. So we were about 18 cents earnings contribution from reserve release. That number you're speaking of was about 20 cents contribution. If I kind of think about my model and run rate going forward, I still think we're probably going to see a mid-teen, maybe 15 cents reserve release, really, for the next maybe 8 quarters. What we're seeing right now is what I would expect is on the corporate side, the reserve release to lessen. I think it'll start to lessen on the card side over the next couple quarters. But I think as we move into 12 and 13, there's a lot of credit leverage left on the retail financial services, and I think that's where we'll see the reserve release now.
Are U.S. consumers deleveraging at a pace that you think makes Jamie Dimon happy?
I think what we're seeing with JPMorgan and the numbers, I don't know if I read across as dramatically with other banks, but we're seeing what Jamie is doing is shifting this franchise from a lending credit risk business to a fee income business. And so we saw credit loan balances down materially, but we saw credit fees go up 25% linked quarter. So what we've seen since 2009 is the ratio of fees to revenues improved from about 42% to 56% this quarter. What that's going to do is help the capital ratios, reduce risk, and increase the return on equity.
David, we're going to leave it there. Thanks so much for breaking down JPMorgan with us. We appreciate it. David Konrad joining us from Keefe, Bruyette & Woods.